Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Chris Dearborn, managing director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq 100 as the index is underperforming relative to the other major averages this afternoon. Chris, it's great to see you as always. Welcome back to Trade Talks, and I have a feeling some of the data that came in this morning is lending to perhaps higher rates for longer. Gas prices are higher, also lends to higher rates for longer.
And you get a rising dollar on top of it too, which is never really good for stocks.
September.
It's September seasonality, right? So it's kind of interesting, right? If you look, the index itself opened at the highs of the day, and then right at 10 o'clock this morning when the ISM number came out, sold off to the lows of the day. And it wasn't a hot sell, but it was a pretty gradual sell-off. We're trying to rally a little bit here. We're still down about 1% on the day in the composite. And we opened at 15,467. We're at about 15,350 right now. It's not really boding well, especially when you talk about the hawkishness that can be read into what's going on. The announcements out of Saudi Arabia on the oil, which is kind of not good for growth, especially if you're looking at China with the situations they have there. More expensive energy, is not really good for growth. You have stronger than expected data, which on a normal day in the ISM would be good, but remember, good is bad and bad is good in this market because it comes down to the hawkishness of the Fed and whether or not they're going to raise rates in November. September's off the table for the most part. It's a 50-50 coin flip right now if another quarter point in November at the November 1st meeting. And if that takes place, then you're going to be looking at higher rates for longer. The question is if they don't, it's still data dependent, but it would be nice to finally see that tail start to come in at the end of 2024, where rates kind of get back down to 4.25%, which will bode well for the markets, bode well for capital raises, and hopefully the IPO market as well, which we're all very excited about.
Yes, we are hearing first and second quarter of 2024, it's really going to ramp up. That's what we keep hearing from our guests. Let's pull that chart back up that we just had. I want to get a fresh look at technical levels that you're watching.
Absolutely. So the index underperformed for the month, it's underperforming for this month. August was a tough month overall, but when you look at the index, still up over 40% year to date. If you look at the bottom of the chart, you see the RSI, we're hitting about a 53 right now, which is kind of that middle of the road uncertainty where we're going to go. What was nice that we had a nice rally to kind of pick up the end of August, and we broke through that 50-day moving average, which had been a headwind for the index for a while. That's now a support level. So the 50-day is major support. It's sitting at 15,272. We should be continuing to bounce off of that. Didn't get there today, but over the next couple of days, as more data comes out, we'd like to see that level hold. If it doesn't, support sits at 15,210 and 14,900 in a very tight level. Resistance overhead is at 15,045, close to where we opened today, and then 15,600. If you look at it from the July highs, we're only down about 3%. From the 52-week highs. So it's really not that bad of a momentum in the index as a whole. But again, the Magnificent Seven is kind of mixed in August. And again, where they go, the index goes.
Right, we're certainly seeing that today. So let's pull up a chart of the constituents leading the way here. I would venture, let's take the over-under on how much green is actually there today, but to your point.
There's more than you think.
Oh.
Really,
but to your point, with Apple as an example, that is having a tough day, it's going to impact the index.
Yeah, news out of China is impacting Apple today. That's off about 60 points in the index, about 3.5% to the stock. The breadth was about 30-70, bullish to bearish when I pulled up the chart. It got a little bit better. It's about 40-60 now. But again, that tail is kind of more flat than anything else. When you look at the big Magnificent 7, NVIDIA's hitting us for about 25 points. Amazon's hitting for about 15. Alphabet with the two classes of stocks hitting for about 15 as well on the negative side. So again, it just
150 points.
Yeah, it just pulls. It pulls the index in that direction, and that's what we're doing. Surprisingly, you got 3 stocks that are making new 52-week highs today too. So even though we talk about the negative breadth, it's really not all that negative. It's just on the weighting of the larger stocks that keep pulling it. I mean, AMAT, KLA, and Synopsys all made new 52-week highs today. And if you look at the number of companies that have made new 52-week highs over the last couple of weeks, we talked about this before, it's broadly based in the index for what the index is, right? The majority is tech, but you're seeing some, I mentioned before, even though you had Intel make a new high just the other day, again, names like Baker Hughes made another new high yesterday. So you're seeing different sectors perform well in this market, and that's what we're kind of looking forward to. So again, the 7 will take us where the index will be, but the tail is really not that bad.
Yeah, I mean, that's exactly what we want to see because, you know, the narrative for a number of months was, okay, there's only a limited number of stocks that are leading the way. And you wanted to see that breadth widen out, and here it is. And you know, it's all timing on the portfolio as well, right? But if you sold out a Magnificent Seven and you just put money into multiple different sectors, so it's all relative to how a PM is running the fund.
I mean, next week is going to be crucial. There's a lot of items going on next week. You have Quadwich at the end of the week. But then you also have CPI, PPI, again, another batch of employment data away from where we get tomorrow. And then, you know, the IPO market's going to open up one of the largest companies expected to price. We hope that they do. And depending on how that goes, may open up the market a little bit there. So again, loosening the purse strings a little bit would be well. But again, higher oil, higher rates, I mean, 2-year above 5% again, 10-year at 4.3%. That's just going to crush mortgage rates. So consumer spending is a little iffy. The expectations are, but then if you look at retail sales, it came in stronger, and then a lot of the other data wasn't as weak as expected. But you know, CPI was the first time we've seen an increase, 0.2%, since last summer. So when you look at that, you know, you've been down month over month over month for almost 11 consecutive months. It's time to see a little balancing people spending, and you do see people spending, especially on food and entertainment. But the problem is they don't have the cash. They're putting on credit cards. There's
right. Well, here's the whole thing too. We had a guest on the show earlier today saying never doubt the power of the American consumer and what they're willing to spend. It feels as if it's more on the services side for sure. We're seeing that in airline prices and hotel prices and so forth. And even when you look at back to school trends, purchases were being made based on need, not necessarily on discretion, right? And I think that, and we saw that in the retail earnings as well.
Right.
It's always the haves and have-nots in retail. This quarter, it really did stand out. I mean, you cover.
I do.
The consumer.
I consumer here, and you're absolutely right. You know, you're going to spend on what you need, right? So you throw the staples out. So when you look at discretionary, where's that discretionary spend? And you look at companies like an Amazon that gets lumped into that, and others, and you're wondering where the growth is going to come. And again, retail spending is robust still. The difference is the money in the pocket from the stimulus packages are starting to wear a little thin, so people are putting on the credit cards. It's the first time we've seen $1 trillion in credit card debt on a quarterly basis. You know, the New York Fed did a nice write-up on it, and when you look into that, you're like, it scares you a little bit. But if you look at it seasonally, it's really not that big of a number, even though it's a shock value of $1 trillion. So when you look at the actual percentage, even though it's up over 30% over the last couple of months, it's not really unheard of on a seasonality basis. And again, you know, then you look at September on the broader market basis, you know, perennially one of the worst months of the year. You know, if you go look back historically over the last 50 years, it's generally down about 1%. But if you look at the data that came out at the end of the month, we're thinking that a lot of that may have been pulled forward. So we're kind of hopeful that September may actually pull out to a flat month with positive tones coming into the end ahead of the October data, which will be for September. And again, remember, the Fed meets in September, but not again until November 1st, and once again in December. So that's where the focus is on the terminal rate, higher for longer or not.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.